Perfect. Okay. Now today I learned something. I hope that I can return this year by also giving some input in regards to mastering your trading emotions and how to take charge of cognitive biases to boost your trading performance. So you probably remember that around 2 weeks ago we had already a webinar on the introduction of trading psychology, and some of you probably have seen the recording on YouTube. If not, please check the YouTube channel from Admiral Markets. And here in this regard, I can say that the feedback was really great, and we want to play the game again today, and we want to dig deeper. As already promised back then, we want to dig deeper into probably one of the most fascinating topics in trading in general, cognitive biases, how you can realize them, respectively also how to formulate a plan to somehow reduce them in your trading, get rid of them, even though getting rid of them is it's quite hard because it's human. It's something you really can't get rid of, and this is something we want to then show here with this little game and adapt this then to the world of trading. So first of all, let's have a look here at today's agenda. First of all, we want to have a look, as usual, at the 3 columns of successful trading, where trading psychology is 1, risk and money management and trading with an edge, trading with a proven profitable strategy is the 3rd column. We also want to dig deeper into the column of risk and money management, then in one of the trading spotlight webinars in the month to come in September. We want to give a short explanation, a short definition of what's behavioral finance. In fact, it sounds really academic to some extent, even though it's a new field in the academic world. So new field means back into the 1950s, 1960s. 2 guys back then brought this to the attention of people in Israel. It was Daniel Kahneman and Amos Tversky. Unfortunately, Amos Tversky already passed away in 1995, but Daniel Kahneman is still alive and also wrote a fantastic book on this topic. I highly recommend, probably one of the best trading books out there, probably the best trading book out there, even though at first glance it doesn't have anything to do with trading. It's called Thinking Fast and Slow. I will give you also an idea. Oh, wait, let me probably do it already now. 1 second. Do I have this open? Yeah, so here, this is the book in Amazon, Thinking Fast and Slow. Also, probably it makes sense to now give you the link in the chat box here. And if you're watching the recording, link to the book. If you watch the recording, then there's also, let me just change this here to all discussion participants. If you watch the recording, please check the box here below the video. There you also will find the link then. Yeah, we want to give an introduction. In fact, it's behavioral economics we refer to. Behavioral finance is a special field of this and something which is then of interest for us as traders. And we want to adapt this to retail traders and to show how they behave under under real market conditions. It's not just something you probably see at one time and then disappearing at another, but it's something which is within, let's say, retail traders all the time. And this is definitely something to be, it's very important to be aware of that. And again, the idea here behind this webinar is to not just make this a topic and show how it can be seen in a real trading world, in a real trading environment, but in addition to that, we also want to give an idea on how to at least reduce these emotions, respectively, those cognitive biases. And yeah, how to profit from the new knowledge in your trading. That's then something which is already showing that this is also on today's agenda, and part, in fact, to some extent, of a daily trading routine. And so before we start, this is me. Also, probably this makes more sense than going through all the details here. Here we did an interview before we started with this webinar series, and probably this gives a better explanation of who am I, where do I come from, and better than to go through all these steps. Only thing probably which is important, my name is Jens, and that's it. So if someone has a question, please feel free to ask the questions in the chat box. And then today we are here with Admiral Markets. It's one of the probably most well-known brokers out there, one of the most well-established brokers in the CFD and FX brokerage right now, with offering over 8,000 financial instruments in all asset classes, so a real multi-asset broker. It's not only FX, equities, but also indices, commodities, bonds, ETFs, for example. And what's also interesting, I already mentioned it right at the beginning, that I'm located in Berlin, Germany. So Admiral, for example, has a very well-established name also in the German trading community, an office here in Berlin, Germany. So I know these guys from the office there. I've been there. It's the same, which is possible for you. Let's say it's not usual, let's say, to go there and to knock at the door. But if you do, or if you prefer to do that, you could, and you could then really talk to a really human being here. It's not only possible via phone in all languages, so it's not only German, also English. In general, 20 countries globally, licensed by the FCA, EFSA, CISEC, ASIC. So in Australia, in this case, then, for example, very competitive offering. In Germany, we refer to Admiral Markets, for example, as the DAX expert, with a highly competitive offering, probably the best one in the market. In regards to the DAX 30, but the same is also true for FX. So I highly recommend really to check out Admiral Markets. And yeah, this webinar series, Trading Spotlight, also aims to give all the people out there, then traders around the globe, some insights into what professional traders think like, and really make them profitable, help them on their way to profitability in trading. Enough from that side. Let's now have a look here at those 3 columns of profitable trading. We already had this, and I already mentioned it. It's the risk and money management, trading psychology, the column we want to focus today on. So it's not the general field of trading psychology we look at today, but what we'll do is we'll look here at the special field, but probably one of the most interesting ones. It's again, behavioral finance. Then the next 3rd column, which I consider to be profitable trading to be built on, is trading with an edge, trading a strategy with an edge. And there you have here you have the let's call it the umbrella. I'm not sure what's the German word. If the German word is Dach, I'm not really sure if I know the English one. Yeah, but however, let's call this the umbrella. It's profitable trading. These 3 columns profitable trading is built on, and so now let's have a look here. Go through all these steps. This is a little unfortunate that it's not here coming in, but let's first of all focus on the definition of behavioral finance. So it's very interesting. Many trading books. It doesn't really need to be a best-selling trading book, but within every trading book, or listening to webinars, go to seminars, listening to professional traders, hedge fund managers, whoever, you will all the time hear that the most common rule profitability in trading is built on: let winning trades run and cut losing trades short. And given that fact, it comes as a surprise that it's so difficult to let winning trades run and cut losing trades short. But there's a reason to that. And if you know the reason why this is the case, by the way, the reason you act that way is because you're human. It's natural. It's within us for thousands of years, and this is one of the reasons why many fail in trading, because they're just human. So it's probably not a bad reason to be unprofitable, but probably one. It sounds like a joke, but you've probably heard some people referring to traders to have psychopathic tendencies, let's say, so not being human, and it's very funny to some extent if you hear that, but I can understand it, because sometimes a trader he takes a decision a normal human being wouldn't take, and you will see what I'm talking about in a few minutes. with a very, very exciting game we want to play here. So it's illustrating this fact really well, I think. So the exciting question which arises then, and which we want to focus on, is why don't retail traders just follow this easy saying, put this in quotation marks here? Why do they hold on losing positions for too long and cut their winning trade short? And it's not only that I say that now, but it's a given fact. And I want to show you with the next slide here that it's really true for a very long period of time. Probably give a little anecdote here on another time span. I haven't prepared a chart for that, but let me just first go here through the rest of this slide then. So what we know already, thanks to the introduction we had here 3 weeks ago, is that psychology in trading plays a crucial role. So emotions come into play. Emotions are part of us because we're humans. Emotions are part of our trading every day. It's anger, frustration, it's fear, it's self-confidence, ego, motivation, actionism. So anger, frustration, you open a trade, for example, and you're fearful that the market probably will turn against you and you get stopped out. And then there's some kind of uncertainty arising from that. And you think, okay, when I lose, let's say, 1% of my account now, will I ever make it back? Then sure, you will make it back, because the ego tells you I'm the greatest trader on earth, because yesterday I had a winning trade and I felt like the best one ever. And that's probably also one of the reasons why you think you don't need to place a stop loss, for example. The market will just go the right direction you want it to go. The same is true in under market conditions where nothing happens. So remember probably the time in school. So everything has some, to some extent, every of these emotions I just mentioned has some history connected to it. Remember what happened in school. If you, for example, had a bad mark in a test or something, or you failed in a test, and then you had to overcome this to how to say that, to make it to the next level, to the next stage in your academic career. Well, you just sat at home and you just worked through the stuff again, and you really tried to get grasp the concept behind whatever topic it may have been. And the interesting thing about this was that it was like you have to just study hard and a lot, and then you will make it through the test. The interesting thing in trading is that if the market does not give you a chance to trade, then you just shouldn't trade. You have a preset and you have predefined rules you follow in your trading, a strategy, which is given, and then the rest is patience. You sit there, you wait for the setup to appear. If it appears, you enter the trade, that's it. And then you can't even say whether that will be a gain or a winning trade or a losing trade. But at the end, it comes down to patience, for example, one of the traits of successful traders. By the way, one topic of next week's Trading Spotlight series here, traits of successful traders. We want to focus on that. But let's come back to motivation actionism. You just think, okay, I have to do something. If I don't trade, I don't make money. And this is something you really have to overcome. And then you have to look at it from a different perspective. Probably in school that worked out. You had to learn more and more and more, and then you passed the test. But this is not necessarily true in trading. If there's no real setup given, well, you just shouldn't trade. And let's just now focus here on one of those emotions, especially based on my personal experience over the years, not only when looking at other traders, discuss with them, but also when looking at me. Fear was one of the main topics, one of the main emotions in trading. And based on these emotions, based on fear, for example, you get to see so-called cognitive biases, okay? So cognitive biases, that sounds very, very academic. In fact, it's something very simple to understand. It's a systematically and flawed tendency when it comes to percipience, remembering, thinking, and judging, which impacts your trading in a negative way. So we will see here such a cognitive biases in the upcoming slides. It's called loss aversion, but probably it's very interesting right now to pick this to pick this topic up here. Let's take Donald Trump as the current US president, and let's have a look here at how you probably have seen the chances of him being elected in November 2016. If I called you 3 years from today back. So we have the 28th of August 2019. 3 years back, it was the 28th of August 2016, 3 months before Trump was elected. And I asked you, hey, what do you think will happen on the 9th of November, the day when Trump was elected, 2016? What will happen? Will he be elected or not? Many, me included, by the way, said, well, probably has a slight chance, but really, I don't really think that. I don't really think that he will be elected because he's not a politician. He's not really like, he's not a, how can we call that? A president, like, right? This is, no, that's no one you can really trust. And I don't really think that he'll be elected. By the way, there was the same thinking, which was 2 months ago true when it came to the Brexit. I never ever thought that this was an option. Yes, sure, there's some tensions within the European Union. And sure, there's many reasons to be very skeptical about this whole product. But in general, so this whole concept of the euro, how it's set up and all this. But in general, you don't really think that people want to come out of their comfort zone here. Comfort zone, in this case, is also, by the way, a cognitive bias. You stay with what you have because you can be certain that it stays the way it is. That's one of the reasons why you probably don't change the broker. So if someone who is not right now trading with Admiral Markets is trading with broker XYZ, you stay with this broker, even if it has obviously a worse offering in regards to FX or CFDs or conditions, commissions, whatever, order execution. You stay with the broker because you think, well, it's like, it's work, right? You have to send up, you have to fill out the form here and give away your details. You have to send over all the documents, legal documents and all this. And well, is it really worth it? That's a cognitive bias. It can be so obvious that trading, in this case, for example, with Admiral Markets is so much better, you just stay with the other broker. It's a cognitive bias. The same is true with the Brexit. The same is true with like uncertainty, which goes hand in hand, electing a president, or voting for a president, which is not really a politician, which is not really a president. If I ask you the same question, what was the likelihood of Trump being elected today? You will say, oh, it was a higher certainty than Hillary Clinton. Well, sure. I mean, look at the Clintons in general. I mean, Bill Clinton was a president. You remember the story with Monica Lewinsky? Can you really trust such a guy? Or look at the story right now with Epstein. No, not really. It was really certain that Trump would have been elected. So you completely misjudge what you thought 3 years ago, right today, which is really, really interesting because this is all based on cognitive biases. If you write the same, by the way, this cognitive bias I just referred to is called as hindsight bias. It's also something we remember in our trading. Oh, I'm certain market goes long here. I'm really certain. If you're so certain, why don't you put your money at the line then and bet on the market going higher from here? Why don't you do that? Well, because you're not certain. And then you see the market going higher and you say, yes, I was so sure that the market would go up. So you were uncertain, even though you thought you were certain, you were uncertain. And then you looked at the market really going up and you said, well, I knew it would go up. No, you didn't. If you knew that, you would have put money on the line and bet that the market would go up. And this is really interesting. It affects your trading, obviously, in a very negative way. And this is what we refer to as cognitive biases. So now let's focus on one of those cognitive biases here. It's called loss aversion. It's here a data where it's a time span we look at from the 31st of March 2014 till the 31st of March 2015. So 1 year. We are looking alone in Euro USD. So you can see here several markets. You can see Euro USD, for example. When looking at these two columns, you're looking at analysis from over 9 million trades. So it's a really large pool. You look at data here, or the data you look at here. And what's interesting to see is the column, the blue one, is the average gain, while the average loss here is the average losing trade. And this is pips here on the x-axis here. So you can see on average, it's around 20 pips you gain, while on average you lose 40 pips. This, by the way, very, very interesting because this column or these two columns perfectly illustrate something which is worked out in a very interesting way then in this book I just recommended at the beginning, Thinking Fast and Slow. Because what can be seen here is that there is a ratio of 1 to 2, in fact, which can then be brought to a point which we will see is very interesting when it comes to how do you feel. So there's joy when I see a winning trade. It's great. I feel joy, but the funny thing about this is that this loss aversion, this natural tendency, this human tendency, is that if I see a loss in the same region, it feels twice as high, or it's 2 times higher. I feel the pain is 2 times higher than the joy I feel when I'm winning. And this can already be seen here. So it's 20 to 40. And that's a very, very interesting thing, in fact. Or to put it differently, if you gain €1, or no, if you lose, let's put it that way. If you lose €1, you have to gain €2, in fact, to have the same level of joy you felt pain when losing only €1. You can also look at it from this perspective. So this chart perfectly illustrates that's a natural tendency. Now let me just give you an idea here on why this is also interesting. It's an anecdote. So I'm also a book author in Germany. I wrote 2 German books, and the first one was on forex trading. I focused especially on sentiment here, and also on average or behavioral finance in this case, how it affects your trading, how you can draw an advantage out of this. And when I had this chart presented here in the book here was published in 2014 in November. So you can see here, I obviously not refer to this chart in the book, but I'm referring to another one. It was a time span from Q4 2009 till end of Q3 2010. And the same was true here. The only thing what is different here were the markets we looked at, but you saw the same exact behavior: cutting, winning trades short, letting losing trades run. And now what's interesting is the following. We have here theory, but it's not really something you can feel. I strongly believe that if you feel something, you think about it in a deeper way, naturally. And that's why I prepared a simple game for you. And I really like you now to ask, or I appreciate it if you join me in playing this game. So it's 2 games. They're independently from each other. It's game 1, and then you give the answer, choose option A or option B, and then you have game 2, and you choose option A and option B. One thing right before we start is there's no right or wrong within the game. Okay, so you can't be right or you can't be wrong, and I will show you why, but after we play the game. But just choose one of the options and just type it down in the chat box. So game 1. Option A is you get right here and now €900. No questions asked. You just get €900 and that's it. Or option B, you have a 90% chance of getting €1,000, but a 10% chance of getting nothing at all. So it's as we never played this game. Okay, we go home and everyone goes with no money taken out of the pocket or put more money back in the pocket or something. We just go home. So the question is now, which option do you choose? And now just type in A or B in the chat box, and I really let's see what the answer is. So we have only 1 right now. 2. So by the way, I will just here make a short list. So it's okay. Okay. So I leave this open now for another 10 seconds. Just type in A or B. Again, it's no right or wrong. Just type in. What's your feeling? What do you think? Which option do you choose? So we have right now what I have here. Okay. Okay. So perfect. Let's end this. So it's quite obvious. In fact, we have a clear tendency, more A's than B's. More A's than B's. So definitely, it's in fact 5-1 here. So okay, that's the first game. Let's play the second game. Game 2, you lose right here, 900 euros. So which means you give me 900 and I go away. I really go away then. If enough people are found here to play the game with me, I'll take something like 5 to 10 people giving me 900 and I leave. Or you have a 90% chance to lose 1,000 euros, but a 10% chance of not losing anything at all. As in one, you just take your money, go, I take nothing, and we leave, and 10% of the chances, and 10% of the cases. So now the question is, which option do you choose here, A or B? No. It's not. This is not an option. So, but it's a smart answer. No option to choose is not an option because you played the game with winning, so you have to play it now for fairness purposes here. Also, in case of losing. So just tell me A or B. Whatever option you prefer, just type it in. So right now we have a very clear tendency. Is there anyone who chose A? So right now it's 5-0 A's. Okay, just let me keep this question open here for another 10 seconds, and then probably the thing is, I'm not surprised. Let's say I'm really not surprised to get this result here. The unfortunate thing is that we are not in a present seminar right now. So we are not having a stage here, but it's a webinar. But usually when I play this game at seminars or at let's say trade fairs or something like that, what I do is I write down the result I expect to get here. I hand the piece of paper then over to one of the moderators here at the booth, and once we're done, I say, okay, now we had game A, clear tendency to A, while game 2 we had a clear tendency to B, and now let's have a look here at my piece of paper, what I wrote down before. I just do it that way. People can see I wrote exactly that down. So I expect people to choose option A in game 1 and option B in game 2. And the reason for that is very simple, because it's human. This is what you expect a classic human to choose, because what you choose as a human is safety. You're looking here for 900 euros. You're not playing any games and betting on another 100 euros, but you're just happy to take away 900 euros and that's it. Or to put it differently, you don't let a winning trade run. The funny thing is, from a mathematical standpoint, you're here, it doesn't matter if you take A or B, because you have here 900 euros, and here in this case, you have 90% and 1,000 euros, which if you calculate this is 900 euros, why you subtract 0, so it's 900 euros, the expected value in both cases. And the same is true here, only with a negative for sign. But in case of losing, you say, if I just accept the loss here, I mean, I have to give away 900 euros, but in option B, how great is that? I have 10% chance of not losing anything at all, and it only costs me 100 euros more. So I take the option where I'm probably not losing anything at all. Or to put it in a trader lingo, you're letting your losing trades run only for another 100 euros. Probably things turn around. I mean, it's really, sometimes we are lucky, right? And we wake on the right side of variance. And this is very interesting because this is the natural tendency, as you can see over here. You cut winning trades short and let losing trades run, or the simple classic loss aversion I was already referring to, a natural human tendency and a cognitive bias which you can't really get rid of. It's the same as if you were looking, let's say, 2,000 years ago, and you had to hunt for the dinner for your family. So if you had a chance to pick only a small piece of meat to get it somewhere, and you just took it, and it, I mean, you could have waited for another hour and have something to eat for the next, let's say, 2 weeks or so, but if you had the chance to take here a small piece of meat and feed your family only for one evening, you are completely fine, right? And this is the same thing why you cut winning trades short. So it's natural. It's in our brain. It's like it's manifested in it, and then we can't get rid of it because it's natural. It's something we live with for years, for thousands of years, in fact. So the only problem now I have is, I already said it, we're playing usually this game here, or I play this game with the audience, but the only problem is sometimes people have difficulties to connect this to trading. And that was something someone once mentioned to me, and since then, I decided here to give this a trading example, and something you probably have seen in your trading appearing over and over again. So therefore, I have here a structure, sequence of higher highs and higher lows. And we say, well, if we break out to new highs, we take a long position. Remember how you feel. Like here, this is the short period where the market moves in your direction. So this purple circle here is the moment you enter the long position, the market moves in your direction. Are you joyful? Do you really go excited? It's like, yes, to some extent, and probably you're happy, depending to some extent on the position size and the P&L you're seeing here. But all in all, it's like, yeah, sure. I mean, sure, the market has to rise, right? Remember, ego in trading, that's natural. I mean, we trade the breakout. The breakouts always work the right direction, or always take on further momentum. I've read several books on technical analysis. It always works. No, it's not working always, and you will have seen that plenty of times on the other side. But nevertheless, the thing is that here, joy is not the right word. You feel somehow happy that the market moves in your direction, but it's not that you get completely excited and really flip out and think, wow, this is what I want to do for the rest of my life because trading is so easy. But now, remember what happened if the market moves in a correction here. If it came down, which is, by the way, necessary to form such a sequence of higher highs and higher lows, the market has, rather sooner or later, see a corrective move. So this is the red line here. How does it feel? How does the pain feel when the market starts to take back some of the gains? It's horrible, right? And be honest to yourself. It's a real horrible feeling. And it's a natural feeling because pain, or no, losses here in this case, so it's not really a loss, but because your P&L still shows a profit. You entered the trade here. If the market moves that way against you, you're still ahead, right? But the thing is that the pain here feels like the market has already taken away all of your gains and all of your joyful feelings, in fact. And if the market moves even further against you, even though it's still showing a profit in your P&L, it feels like a losing trade already. And this is something which is then rather sooner than, or not rather sooner than later, but taking over here, the emotions taking over, and you said, I can't take the pain anymore. And I just cut here the trade out and take it out, and I just leave it with that. I still have a small profit, everything's fine. We don't really know what will happen afterwards, but the thing is, here the cut winning trades short becomes a topic, because just imagine the following: the market breaks out, but it's a fake out, and then it turns here lower. This is not what I illustrated here within this picture, but what we also know is here, if we place our stop, let's say, below the last relative low, which is natural in such a trend sequence, or long sequence here, this is the risk you're taking here. If the market moves against you, how many times have you sat in front of your screen and just thought, oh, please turn around, just please turn around? You were hoping that the market will turn around, but you never thought about something like scaling out, or here cutting the losing trade short as you did here, and took out the trade with a small gain. But what you did was hoping instead. Probably some of you worked with a so-called alibi stop or shadow stops. Shadow stops is like you try to catch your shadow, but you can't really catch it because it's your shadow, right? So, and the same is true with the market going after your stop here. It's a shadow stop because the market tries to catch the stop, but it can't catch the stop because you're just taking it away from it over and over again, and just hope that market rather sooner or later will turn around. You let your losing trade get out of control here. And this is then the parallel, let's say, of the game to the trading world, to the real trading world. And so now let's focus on 4 cases of loss aversion. I have to say the following: the table I prepared here is not a table I prepared but I took it away from this book, Thinking Fast, Thinking Slow, from Kahneman, and adapted it to the trading world. So if you want to see this in the real world, please feel free to check out the book, as I already said at the beginning. So these are, let me just see. Yeah, okay, perfect. So these are those 4 cases here. And let's go through each of these. First, it's let's call it the sure bet. It's a case of winning, okay? You have a 70% chance of winning another, let's say, 1,000 euros. So to put this in a trading perspective, we have where we try to anticipate a breakout. And we expect the market to really move strongly in direction of the breakout due to the significance of this region. We really can't be sure, but let's assume chances are definitely higher than 50%, something like 70%. And if the market really takes on this momentum, then we have a chance of winning another 1,000 euros. So the thing is that even if we have a positive expectancy here, we are feared of any disappointments, of any potential fake outs, and instead of waiting for the breakout to happen, instead we go for a quick profit taken instead of going for a profitable, even more profitable breakout on the upside. So this is when I refer here to game 1, and it's option A. So you're not going for probably winning 1,000 euros instead of 900 because you say, if I have 900 or 1,000, doesn't really matter because it's only 100 euros more. And a 90% chance is still profitable in this case. So it's like if you have a 90% chance of winning, it's likelier that you will make those 100, 9 out of 10 times at least. But the fact that you fear the loss so strongly results in you taking here the profits in a very quick manner and just not betting on giving the market the room to move in direction of the breakout. And a case of losing is the opposite of this medal here. So it's a 30% chance of losing part of the accumulated gains. It's in fact, it's the same thing. I already described it, but only in a different matter here. It's a fear of losing pain instead of going for the profitable bet and trade. And this is something you will know out of your trading. How many times have you sat in front of your screen probably and thought, well, if the breakout happens, yes, it looks really like a interesting setup, because if really a market breaks out here, this is great, but I have already a positive 4 sign here on my P&L. I already made some money, and probably I'm not really going for this breakout here, because if we do not make it and the market bounces back, well, I'm losing one of the hard-earned money, let's say. And that's why I take out the trade. At the end, if you do this often enough, you have to have a quite high hit rate, because the average gain to average losing ratio here is not capable of overcoming the hit rate compared to the losing rate, giving you an overall unexpected or expected value, negative expected value, which means losing money in trading. So, and then we have also here the low probability, the risky bet. Even though I have to say, and I have to really to say that I want to be honest with you. So sometimes I like to gamble, not in really when it comes to trading. There's something more to it. It's the intellectual challenge here. But let's say going to a casino, for example, playing some roulette, playing some blackjack, playing some poker, wearing let's say a dinner jacket and have your wife with you in a nice red skirt and feeling like James Bond. I mean, that has some. It's some charm which has this feeling, but still it's a negative. It potentially negatively affects your trading. It's here I try to describe it as a 5% chance of winning 1,000 euro. It's like a lottery principle, and you just hope to get lucky. It's like waking up on the right side of variance, and this is what I mean with nevertheless. But probably I also try to somehow justify my tendency one day here to play around a little. I refer to this as a asymmetric risk reward profile. It's similar to a call option. You just have a small amount of money you have to bet here, but to gain, let's say, 1,000 euros. And sometimes, again, if you get lucky, you really get lucky in a huge way. And this is probably something you can afford. But the opposite is here, and this is probably something, we know this as sunk cost fallacy. This is horrible. And it's the guaranteed way to crush your account. It's a 95% chance of losing 1,000. It's like we already showed in the second game, game 2, and here then with we're saying, okay, I already lost 900, so probably it doesn't really matter if we go for 1,000, then it's only 100 euros more. It's the hope that things will turn around and that the trade won't be a loser. It's typically taken then the stop out then and saying something like, I've already lost so much, it doesn't really matter. And this is sunk cost fallacy. Is a known fact here in trading. It's one of the main reasons why especially retail traders bust their accounts. So this table is already giving you a good idea on how this negatively affects your trading. So now the question, how do you profit from this knowledge in your trading? So first of all, let's come back to the ego thing here. If you have a winning streak, you naturally feel sometimes excited. You think you're the greatest, even though it's not really that you think, okay, I woke up on the right side of earnings, but it's really that you think you have what it takes to be a profitable trader, right? So and if you gain this self-confidence and you feel invulnerable, you have to probably use a technique I used to call inducing rational thinking here. And actively, before entering, in fact, not when, but before entering a trade, you have to actively find reasons why the next trade could fail. That's something also business people, for example, refer to as pre-mortem analysis. This is one way to overcome these cognitive biases. So really think deep about the trade. So I bet if you do this accurately, one definite positive thing is that you will never ever trade without a stop anymore, because what you see when doing this correctly is your trade could be a loser. And so you're not the greatest trader on earth, but the trade could be a loser. You could be on the wrong side of trading. Something which is, it doesn't really need to be explained, but still it needs to be re-emphasized over and over again, because I came about this phenomenon here over the years, over and over again. There are people out there just thinking they can call the direction of the market. And so the thing is, when they are then wrong, they're most likely wrong in a big way, and this is most likely resulting in a potential crash of the account. Then on the next thing, something we will see then in the risk and money management webinar, Trading Spotlight, in several weeks from now. If you grasp the concept of expected value, you understand that trading based on cognitive biases will result in bad results in the long term and increasing your chances of going broke, which means you have, for example, to formulate a trading plan, a clear idea of what you plan to trade, which markets, which assets, products like, is CFD the right product for me, for example. Then you have to test it, the strategy, the approach you're planning to trade. And if it works, then you have a robust approach, which means you have a positive expected value and the risk of ruin of 0. And then you just go with it and you trade this plan. And also stop fighting writing your strategies and your trade. So if I ask now the audience, hey, do you have a trading journal? Many of the audience or the attendees here will probably say, no, I don't really have it. Or if I have one, it's not that I write down everything in detail. And the reason for that is also, it's based on cognitive biases. Most people do this to avoid getting a result that shows that they're doing something wrong. If there's a negative force sign, obviously what you do does not work, especially not in the last days. And what you do here is you self-defend yourself. So which means you have to overcome this. Ego is the wrong, is the complete wrong way to go here, but make it something positive. Making mistakes and knowing them gives you a chance to change something and get a positive result in the long run. And this is really something which will positively affect your trading. So write down your trading, work with a trading journal. This will definitely reduce negative emotions in your trading because you're not cognitive biased anymore. Like, oh, wow, I have such a great run or such a bad run. But then you find out when writing it down, oh, I only had 4 trades in a row, which showed a profitable result where I made money, but the average gain was below what I need to have an overall long-term positive expectancy in my trading. This is something which is really worth it. And it works the other way around too, also with losing trades. So let me just now probably finish here something with the daily trading routine, which is very important, because if you follow this, then also cognitive biases are reduced in your trading. So I always recommend people to start out, for example, with a demo account. That's usually the usual way to go. You have a profitable strategy. So look at the recordings here in the YouTube channel in regards to DAX strategy, also S&P 500 strategy. We had this the last 2 weeks. You have profitable approaches there already. Trade them in a demo environment, do trendy trades, and then you record your results in your trading journal. So this is the first step to document your trading. So then you review it and you analyze it. So you calculate the hit-loss rate, for example, of those 20 trades. And then you filter areas causing underperformance. So if you failed for some reason to take the trade because of an emotion, I fearful or something, which is probably not such a big topic when trading demo, but still sometimes demo trading can show you things you haven't thought of before when you really never traded in a real environment. You filter out those underperformances, and then you start to improve. So you ask the question, how can I get rid of these identified mistakes? You then implement the change and you repeat. You start from here again and you go through this. This is not only reducing emotions in your trading and cognitive biases, but it's also resulting in you making first steps towards something we refer to as unconscious competence then. Yes. And with that, I already saw it in the chat box. I have to hurry up. We go through the conclusion. Cognitive biases are completely natural in all of us and thus human. One thing. So it's nothing to be scared of or which is bad. But being aware of cognitive biases in your nature and trading are not enough, but it emphasizes the importance of formulating a proven profitable approach and know what you're doing all the time. That especially includes questions like, what's the hit rate of my approach? What's the profit factor? How long can losing streaks go on? And so on. And then be 100% aware of your trading will only reduce cognitive biases, but they're still there. So I really think that you can't get rid of them, but that's sad. If you work with this technique of inducing rational thinking, it is important. This is an important part of avoiding tilt in your trading, which means especially when you're in a losing streak. And so now, very important, on Friday, Marcus will be here in Trading Spotlight here, talking about technical and fundamental analysis, including benefits of those two analytic approach here, when to use each type of analysis in your trading, how to successfully combine both types of analysis for your trading success, and what you can also see here, Friday. Same time, 1 p.m. GMT, it's August 13th then, and check your inbox then for the webinar link. And if you're watching it on YouTube, please feel free to check out the website here from Admiral Markets and register there for Trading Spotlight. You can find more analysis education here. And thanks for your attention. I hope that you enjoyed the webinar as much as I did preparing the stuff here I presented to you. And all the best from Berlin, Germany here. So happy trading. Watch your stops. Talk to you next time. I look forward to it. See you. Bye-bye.